and welcome to BDO's webinar on managing transfer pricing issues in an evolving BEPS environment. Thank you for joining us today. We have an exciting program, and I hope you will enjoy it. My name is Anton Hume. I'm chair of BDO's Global Transfer Pricing Centre of Excellence, speaking from London. I'm joined today by BDO colleagues from the four corners of the globe. Dan McGowan from Canada, Vina Parika from the US, Richard van der Poel from Spain, and Jay Tang from China. As an introduction to today's webinar, I'd like to say a few words, if I may, about the transfer pricing aspects of the base erosion and profit shifting project, its direction of travel, and at a very high level what we can expect it to mean from a transfer pricing perspective on its conclusion later this year. So BEPS has emerged from a widespread public concern and other pressures that led to the G20 leaders in July 2012 to call for reform of the international tax system. A 15-point action plan emerged from the OECD, and needless to say, transfer pricing emerged as a major focus of the BEPS project. In particular, the action points dealing with assuring that transfer pricing outcomes are in line with value creation, with a specific focus on the role of intangibles, risks and capital, and other high-risk transactions, which are all seen and have been seen by major tax authorities as a particular area of tax risk for some time. Other areas of particular focus of the action points include re-examining transfer pricing documentation, in particular examining suitability to meet the objectives of the BEPS project, making dispute resolution mechanisms more effective, and developing a multinational instrument to make exchange of information more effective, which is seen as absolutely key to meeting the objectives of BEPS, as we'll see shortly. Much of these issues have indeed already been dealt with by the OECD. Indeed, the documentation part of the BEPS initiative has been finalized, including the proposal for the introduction of country-by-country reporting. But we will expect some further guidance shortly on issues like hard-to-value intangibles, cost contribution arrangements, and information sharing in connection with country-by-country reporting, and perhaps most significantly on the development of a multinational instrument which is exercising the greatest brains in the transfer pricing and tax world at the moment at the OECD. So what does BEPS mean for transfer pricing? To my mind, it will mean that there will be much greater clarity on transfer pricing principles, and in particular the importance and role of substance and control functions in the context of transfer pricing. It will mean that we have documentation requirements which are far more exacting than we've been used to in the past, and that are fit for purpose in the context of the objectives of BEPS. And finally, it'll mean that we have more immediate and transparent access to relevant information to improve tax authorities' ability to risk assess for transfer pricing, and indeed for tax more generally, including an expected significant increase and ease of access to exchange of information between tax authorities. So this really brings us to the focus of our seminar today. What does this mean for multinationals? It means that they need to pay much more attention to transfer pricing, much more attention to substance and control functions underpinning transfer pricing, its management and monitoring, and its documentation. And it's the management and monitoring aspects of this and substance and control that we will examine in far greater detail today. So let me now hand you over to Dan McGowan, who will speak about our first topic, which is control over transfer pricing policies and procedures. Thank you, Dan.
Thank you, Anton. Thank you for that great introduction. Let's move forward and look at control over transfer pricing policies and procedures as will be required in this new age of an evolving BEPS world. But when we think of control over your transfer pricing policies and procedures, we're really focusing on the 4 main stages of your transfer pricing life cycle. And what it will require is more proactive and deliberate approach to planning for your transfer pricing in light of possibly new acquisitions, new transactions within your multinational group of companies, and lessons learned in the course of transfer pricing audits that will lead you to have to refine your transfer pricing policies and procedures. From that, you get into implementation, and we'll talk a bit about things that you need to do in the implementation phase. But through all of this, it's a continuous cycle of improvements over time to tighten your transfer pricing environment, make it more robust and defensible. From implementation, then you look at documentation and where do you really need to focus your documentation efforts? Where do you face any potential risks and how do you mitigate those risks? How do you report to the tax authorities in a compliance mode? And then monitoring your transfer pricing to make sure that the policies and procedures that you set out are actually being followed in all the jurisdictions around the world. So if we look a bit closer at planning and we think about what's involved there, you're going to need to determine where your intangibles are created, owned, maintained, and used. And intangibles, as Anton pointed out, is still the subject of much study and debate at the OECD, and we're expecting more guidance to come with respect to those. There's going to be a need for more robust analyses of functions and risks. And when you think of these 2 first bullet points, intangibles, functions, and risks are the profit drivers of the business and the profit drivers that are going to determine how much profit should be left in each jurisdiction based on the assets that they own and or use, the functions that they perform there and whether they were high value functions or low value functions, and the risks that are borne and whether those risks are significant or relatively insignificant. So all of that factors into how much profit should an entity within your group of companies earn. Critical to all of this is there has to be economic substance to underpin the desired commercial and anticipated tax outcomes. So you want to make sure that you have the substance that can support your transfer pricing policies. Substance is going to be key as we move forward because the whole BEPS initiative came out of, in a large part, there were a lot of setups or structures that did not have enough economic substance to support the transfer pricing that was taking place within those arrangements. Underlying all of this, you've got to look at your value chain and analyze the strengths and the weaknesses of that value chain. Look at the areas for improvement and the areas of focus framed by the realities of your business, because there are certain things you can and can't do with your value chain, but you want to make sure first and foremost it works from a business perspective. And once you've looked at that, you should have a review of the potential appropriate management of your effective tax rate in the context of all of the above. When we look at implementation, your efforts should focus on the preparation of a transfer pricing policies and procedures manual that will guide the individuals taking care of your transfer pricing within each of the entities in your group of companies to ensure that your policies are being implemented appropriately and in line with the planning that was done. This will require clear communication of those policies and procedures to all of the entities within your group. And what we would recommend is that you actually have training to ensure that the policies and procedures and the expected outcomes in terms of operating margins or operating results are fully understood in order to facilitate this proper implementation in each of the entities in each of the jurisdictions. You will want to have controls over that implementation process to make sure that it goes as smoothly as possible and that you are online when you want to be online with all of this. And then have ongoing monitoring procedures to ensure that the implementation does take place within the time frame that you want and the way that you want it to occur. You should also include procedures for taking corrective action when required to make sure that your implementation is coming along the way that you want it to come along. Once you've got your policies and procedures in place, you're going to have to focus on your documentation requirements. And as we know, Chapter 5 of the OECD guidelines has been revised by the OECD to incorporate 3 levels of documentation. And so what's going to be involved is the preparation of a robust master file by the parent company of the group. And the master file will show you a picture in a moment of what the master file entails. But as you can imagine, it's a high-level view of the functions, the risks, the assets within the group of companies, what the value chain looks like, what the overall transfer pricing policies are, and things of that nature. You want to determine which entities in your group will be required to file or required to prepare a local file, and that will largely be driven by whether the country has specific transfer pricing penalties and or there's a risk of adjustment in that country just by virtue of the country that you're operating in. Consideration will also have to be given as to whether the group has to file the country-by-country reporting template prepared by the OECD, and if so, where is it going to be prepared and where is it going to be filed? And then you will need procedures to incorporate the review of all documentation studies, both at the local level and at the central level, to ensure that you're getting consistency across your documentation in line with your policies and procedures. So if we look at revised Chapter 5 of the OECD guidelines, and this is just a snapshot of what I was discussing on the previous slide, where you have the master file with the high-level overview of the group's business, and it will be filed directly with the tax administrations in each jurisdiction as required by those administrations. You will have the local file, which is to provide the individual jurisdictions with detailed information on the transactions that are occurring within that country and that are considered material to that country's tax system. The local files are meant to establish how the taxpayer has complied with the arm's length principle with respect to transfer pricing for all of its transactions. And the local file is to be filed with the local tax jurisdiction in accordance with local tax laws. The country-by-country report, on the other hand, is an aggregate jurisdiction-wide assemblance of information on global allocation of income, taxes paid, and other indicators of economic activity, such as total assets and number of employees. This is really designed to be a risk assessment tool for the tax authorities around the world, for them to evaluate not only transfer pricing risk, but also other BEPS-related risks. This country-by-country report will be filed by the parent company with the parent company's tax authority, and then through mechanisms in the international tax treaties shared with other tax authorities. This is not supposed to be used as a basis for proposing adjustment on taxpayers, but it is to be used as a risk assessment tool to determine where the tax authorities are going to devote their resources. Monitoring is as critical as planning with respect to your policies and procedures with respect to transfer pricing. And this will involve delegating review responsibilities to the key individuals at the local entities and at the parent entities to ensure that there is someone responsible for overseeing the transfer pricing at each level within the organization. And then having those individuals report into a central leader within the parent company to ensure that we have control within the parent over everything that's happening around the world. You'll want to be able to identify issues that are encountered during the monitoring process and take corrective actions when you encounter some anomaly that should not be occurring given the policies and procedures you have in place, and then reporting back to the central leader with respect to how much control there is and whether there are anomalies and what's being done to deal with those anomalies. But as you can see, over the course of this whole transfer pricing life cycle, deliberate control, deliberate planning is going to be critical to the success of safeguarding your transfer pricing. With that, I'm going to hand it over to Veena Parkar, and she's going to talk to you about planning.
Thank you, Dan, and good morning, everyone. This is Veena Parikar, and I'm speaking from San Jose in the United States. Speaking about excuse me. I'm going to be talking about effective transfer pricing planning. All transfer pricing planning begins with the value chain. In fact, the very heart of international tax planning is the value chain. Value chain, as is also known as supply chain, as everyone may have heard before. What exactly is a value chain? A value chain is a full gamut of a company's activities, starting right from concept to the sale of the product until the revenue is collected from the sale of the product. So taking a product which is familiar to all of us, potato chips, for example, who comes up with the concept? How do you get a good product? How do you make it crisp? How do you package it? All of the activities that go into getting that product, the potato chip, from concept to market is what constitutes the value chain. So R&D, procurement, manufacturing, logistics, distribution, and aftermarket. Why is the value chain important? It is because all of the profits that are generated through a business are allocated to all of the value drivers in the business. So prior to the BEPS initiative, the value chain and economic substance identification was a fairly simple process. All you had to do was characterize the entity and come up with the transfer pricing. So for instance, you could have a contract manufacturer in Germany, and you could assign some low risk to it and put it on a net cost plus basis and give them a low return commensurate with the low risk. That was before the BEPS. Now, under the BEPS regime, things have changed. It's no longer sufficient to characterize and follow your transfer pricing according to this characterization. Just to give you an idea about the importance of substance in the BEPS regime, out of the 15 actions in the BEPS initiative, 5 of them focus on aligning taxing rights with substance. And action 5, there is a full action 5 that focuses on substances, focuses on companies using preferential tax regimes. So think about Google, think Starbucks. what is substance and how do you recognize it? There is no single definition of substance, and so one has to rely on different sources for understanding substance. Fortunately, the BEPS initiative and the various actions and discussion papers have provided significant guidance on what substance is. As a starting point, it's helpful to think about in the U.S. tax law, there is a doctrine which says that a transaction must have economic or business purpose other than merely reducing the tax. So taking that as a starting point, we can think about substance as typically, in three simple words, what are the significant people functions? So in other words, what are the responsibilities of the people on the ground in the various entities? Do the people have the requisite skills and the capabilities to perform these functions? How do these functions relate to the value chains, and what are the other options realistically available to all of these entities? The four boxes shown in this slide give you an outline to think about substance, starting with economically relevant characteristics. So as an example, what are the contractual terms of a transaction? What are the functions, what are the risks, and what are the assets? So if we take contract manufacturing as an example, so is there a legal agreement that lays out who is doing what in terms of the day-to-day activities for contract manufacturing? The other thing to consider is also, what are the other options that were realistically available to the four parties, to the parties to the transactions? Could they have hired, for instance, third parties to do the contract manufacturing? Could they have, instead of doing contract manufacturing, could they have developed IP on their own and marketed the product on their own, and so on? One also has to look at the unique and valuable contributions that each entity is making to the process. And each of these boxes is actually elaborated in the following slides. So going on to the next slide, if we're talking about intellectual property actually forms the very basis, and it's at the heart of some of the disputes and controversies that have arisen in transfer pricing. So where IP is concerned, companies have to think about all of these five boxes here. So who develops the IP, who enhances it, who maintains it, who protects it, and who exploits it. The one thing that I would like to point out here, and it's important in thinking about substance, is that legal ownership and economic ownership are two very different things. So looking at the last two boxes, protecting the IP and exploiting the IP are very different things. So you may have one entity as the economic or beneficial owner of the intellectual property. However, the legal owner might be some other entity, and it's the legal owner that typically has the responsibility to protect the IP. RACI is another nice way of thinking about substance. So RACI stands for responsibility, accountability, consultation, and information. So for any function that drives value in an organization, think about who is responsible. So let's just take the contract R&D as an example. So if there is a project, who is responsible for actually planning the project and delivering the project on a day-to-day basis? Who is hiring the staff? Who is managing the staff? And who has day-to-day oversight of that contract R&D? If you're trying to determine who is accountable, then one has to look at who approves the projects, who makes the strategic oversight. So for instance, you may have a lot of R&D functions going on. You may have engineers who are hired in China, for instance, to do contract R&D. However, if they are taking strategic guidance from another country, if the CTO and the chief R&D officer are sitting in another country, then it's the other entity that is accountable for the project. So accountability also goes to who makes the stop and go decisions and who is the one who actually interacts with the stakeholders of the company. Consultation goes to looking at who is it that has the necessary experience to be consulted on the various R&D projects, who provides agreements, and who needs to be buying into the decisions that are made. Information. So who is being informed of the results of the R&D process, and how are they using the information? Are they deriving any benefits from this information? And if so, what payment are they making for getting that information? So all of these 4 boxes, they are very helpful in identifying substance with respect to any particular activity. Next, we go on to the concept of moral hazard. Now, this is one concept that is particularly tricky that has been introduced in some of the actions of the OECD. Moral hazard, in very simple terms, refers to a situation where the parties do not have incentive to guard against risks when they are protected from the consequences of bad actions. One of the questions that we frequently get, and it's a very valid question, is when you have, for example, an entity that is considered low risk and they are put on a cost plus reimbursement remuneration for their transfer pricing. All of their costs are covered, and on top of that, they get a small markup for their activities. So the question we encounter is that how do we ensure that this entity is going to be mindful of what they are spending? They are going to be mindful of managing costs if they are going to be reimbursed for everything they do. So that's a moral hazard question, and the OECD actually recognizes that in third-party situations, so if 2 parties are unrelated and they are acting at arm's length, there are inbuilt mechanisms to prevent moral hazard. So they make sure, each party makes sure that the other will be punished for any consequences or any actions that may result in negative consequences to the transaction. However, in a related party situation, because of the common control and because the interests of the parties typically tend to be closely aligned, moral hazard is less of an issue. And so for the OECD to require that in order for substance to exist, there have to be mechanisms to prevent moral hazard is a bit of a, I would say, it creates a bit of a dilemma for taxpayers in that it's difficult to find comparable transactions that are exactly similar to the related party transaction in terms of the moral hazard issue. So bringing all of this together, how do we make sure that a transaction has substance? On the right-hand side of the slide, you will see 3 different boxes, starting with the functional analysis. This tends to be the biggest, the most important and biggest step of all of them, recognizing the value chain, understanding what the key drivers are for the business, figuring out who is doing what function, what assets are being used, what are the risks that each entity is undertaking, and how is all of this being managed? Who makes all the decisions? Who bears the consequences of those decisions? So functional analysis, it tends to be the major part of understanding and recognizing substance. Once you have figured out the functions, assets, and risks, the next step is to make sure that all of this is properly documented. And by documentation, we are not merely referring to a transfer pricing report. It also means that there have to be contracts in place. There has to be evidence that the transfer pricing policy and the contracts are being followed. So, for instance, do the books reflect your transfer pricing policy correctly? Do you have emails that can evidence the fact that so-and-so is taking all of the major decisions? You also have a good demonstration of how all of these functions fit into the wider business organization and the value chain. So all of these three facets go towards evidencing and establishing substance. Now, having understood substance, there are obviously some practical issues that arise. Functional analysis tends to require a lot of groundwork. You need to be talking to the different departments. The different departments may be scattered across the globe in different countries. The second challenge that we have also frequently encountered, I wouldn't say it's a challenge. It's more of a way humans are. Everyone thinks that they are key to the business organization. So, for example, when we talk to salespeople, we come away with the impression that this company would not exist were it not for the salespeople. And then you move on to the technology department, and of course, technology is key because without the product, how would the company be in business? And then in another instance, we talk to, for example, the CFO, and the CFO may point out, well, all that is well and good. Technology is important. Of course, sales is important. However, a lot of our profits are being driven because we have this very favorable vendor contract, which gives us these raw materials, for instance, at well below prices that our competitors get. And so identifying value drivers to the company can be a little bit of a tricky process, and it requires that you're talking to a lot of the people within the company, and then you have to interpret the data accordingly. There's also the challenge of who manages and administers the day-to-day transfer pricing. There is, of course, the central headquarters that, as a general principle, it's of course beneficial for the headquarters to be managing all of this and controlling the transfer pricing documentation. However, that being said, the local entity is the one that has to deal with the local tax authority, and so to some extent, the local entity also needs to be properly informed and aware of the strategic objectives of the global transfer pricing policy. So the question of central versus local and how much is managed at each level is also very important. The frequency, how often do you review and make sure that you're documenting all of this? The business changes, of course, as everybody's aware. Sometimes things change on a day-to-day basis. Emergencies may arise. Things may be being done which should not be being done. So, for example, if the IP has been moved offshore to another entity and a contract has to be signed for the foreign jurisdiction, it may be a holiday there. The contract needs to be signed right away. Someone in the US might just sign it simply because they are unaware that signing the contract has consequences, tax consequences, and it may affect the structure. And so the frequency and the timing is also very important. Quantifying the risk versus benefit is another important aspect of making sure that substance is properly documented and evidenced. Moving on to the next slide. How much detail does one need? How much evidence is too much? How much is too little? So This is something that depends from business to business. It's, of course, very important that all of the major decisions of a company and all of the critical decisions are properly documented, whether they are in the form of board minutes or emails and so on. There's also, in today's world, given that people sometimes wear many different hats. So you may have a CEO who may also be a director of the foreign entity. He may be a CEO of the U.S. company. He may be a director of the foreign entity, and they may be signing contracts all over the place. So, you know, how is that to be managed? Because each of the place where a contract gets signed may also have important implications for the tax structure. So it's managing all of this on a day-to-day basis takes time and it takes effort. Financing arrangements are also key. How are some of these activities funded? Where is the cash located? Who does the cash belong to? And how do you get the cash to the place where it needs to be? So these are other aspects of substance that need to be taken care of. So to bring all of this together, a few key points need to be remembered. So the first thing is that substance is definitely not tied to legal form. So you may have heard of the phrase substance over form. So the legal document is just the form of a transaction, whereas the substance is actually something different. Substance is determined by all of the key value drivers of the business. And of course, the value drivers of a business will be different from industry to industry. So what may constitute substance in one industry may not do so for another. Another point to remember is that seniority is not necessarily imply substance. So a title is not sufficient and a rubber stamp is not sufficient. The other thing to remember about substance is that it's not set in stone. So because the business is dynamic and changes and people are moving and the business is moving rapidly, so substance and the documentation requirements might change frequently. And of course, financing is also an important aspect of substance. So what do taxpayers need to do in order to get comfortable in this evolving BEPS environment? One thing to remember is that if the transactions are not properly backed by substance, there is a risk that the transaction may not be recognized by the tax authorities and it may be completely recharacterized. So, for example, if one says that the entity in Germany is an IP owner, but there isn't enough evidence to substantiate that claim, then Germany could be recharacterized as something else, just as an example. Substance is needed to make sure that you're not getting double taxed, and then there are other aspects of tax that you need to think about, not just income tax. There may be VAT considerations and other tax considerations to think about as well. So effective transfer pricing planning can help you manage all of this in the evolving BEPS environment, because transfer pricing helps you not just to document and comply with the local transfer pricing rules, it also helps you manage the value chain and get a very favorable global effective tax rate. And with that, I'll pass it on to Richard of Spain.
Hello, everybody. Let's talk a little bit about implementation and monitoring. The implementation and monitoring process is basically a circle, which means that you will always start from the point of collecting information, and you have to decide whether this information gives rise to certain changes that would lead to the conclusion that a policy needs to be changed. If it does, then obviously you have to plan your new strategy, implement it, and document. And then basically the circle starts all over again. Now, to do this this process effectively, there are basically 4 factors that are really, really important. The most important factor are people. You need people to collaborate. People have information. People obviously have their normal jobs, their behaviors, and in the end, that is all determined for the transfer pricing in the group. You also need procedures. You need procedures to collect your information, both financial information, information about the operations of the company, and you need documents that both describe the policies of the transfer pricing system, the procedures themselves, and obviously you also need the contemporaneous documentation which is required in the local countries. And in the end, and that is also very important, you need some sort of tool to support the procedures and the whole process, which nowadays is very easy if you use some sort of technology. Now let's talk a little bit more in detail about these 4 factors. Now the first question is which people need to be involved. I think it's very important to stress that transfer pricing should be at any time a central responsibility. There should be some central coordinator or a whole department, depending on the size of the group, that supervises the transfer pricing policies, their implementation, their monitoring, and their definitions. But those people won't be able to do the work by themselves. So what you also need is people that may perform certain actions that affect the actual transfer pricing systems in the group, or rather their omissions if they do not act accordingly to the transfer pricing policies. What you also need is people that can provide information, and that is a more broader term. So one thing is about behavior, that's the first group, and the second group is the people that can provide information. And you need information basically to assess the level of compliance of the group with the transfer pricing policies and their strategies. You obviously also need information you require to prepare the transfer pricing documentation, which in most countries nowadays will have to be done on an annual basis. And you would also like to have information that can provide indications about any frictions there may be in the group that may give a danger to the effective application of the transfer pricing policy. And finally, in general, any type of information that is an indication that the business model is changing, and obviously nowadays the project cycles and business cycles in general are very short, which also means that the transfer pricing policies in many groups are not so stable as they used to be. Now, when we use these people, it is important that we stimulate the behavior that we require to have them act the way we want and to provide the information that we need. So it's very important that these individuals understand the importance of the transfer pricing policies. Now, how do we do that? We can and we should provide them ongoing training and also preferably central access to training material. They should know where to go to if they have any questions. But we should also be able to review their knowledge. So sometimes transfer pricing manuals are prepared or training materials prepared that is being sent to local entities, and then nobody really knows if they have understood it. So there should be some sort of procedure, and that can either be a telephone conversation, a visit, or something more comprehensive to assess whether they actually know what they should do. And finally, there should also be some sort of a help desk function, which is basically the telephone that people can use to ask questions. Now, it's very important that the roles in the transfer pricing implementation and monitoring process are clearly defined. So it's all about responsibility and accountability. And finally, it should be clear at any stage that there should be a central ownership of the whole process, preferably in the holding company. Now, the documentation that needs to be implemented are basically four types. First, there's the transfer pricing policy document, and this actually is a very high-level document that describes the pricing mechanism for the specific transaction type that are occurring in the group, and it also should have preferably an explanation of the logic and the critical assumptions behind these policies. Then there should also be contractual agreements. The contractual agreements are very important because in the end they are the legal form in which the transfer pricing policies are laid down. And they are also important in situations where certain risks actually happen, and there may be a discussion about which party should assume that risk. So the contract in that case should be clear on that. Then there's the transfer pricing procedure manual, which should basically be a practical document that describes the internal procedures to enforce the transfer pricing policy and to make sure that the information arrives to the appropriate persons. So it should give an overview of the roles and responsibilities of those people. It should also describe which actions must be taken by those people. So that can be anything like general reporting, the annual documentation, what should be done in certain ad hoc transactions, etc., etc. But it is also important that it describes what should not be done. So every now and then there's a certain transaction which is not foreseen, and it should be clear that in that case the actions of those people may affect the transfer pricing of the group. So they should consult with the central responsible person to make sure that there is no risk in the group in transfer pricing. And finally, the manual should also describe the internal and external deadlines for the provision of information, preparing the documentations, etc., etc. And at the final point is the configuration documentation, the annual documentation that must be prepared by the local entities, which, as Dan already described, consists of the group master file, which is basically a central responsibility, although it depends on information provided by each of the local entities, and the local files that requires more involvement from the local entities, because that is where the actual pricing of those entities is being explained. Now, about the procedures that should be in place are the communication of transfer pricing policies in the organization. So how do we achieve that the procedures are being known, the policies are being known throughout the organization? We should also have procedures about how to collect information from the operational units, the responsible persons, to assess the compliance with the policies, to identify any changes that could create threats to or opportunities from a transfer pricing point of view, and also obviously to prepare the mandatory transfer pricing documentation. And finally, there should also be a procedure for the training and assessment of the performance of these persons that are involved in the whole process. Now, finally, let's talk a little bit about the technology that we can use to facilitate this whole process. Nowadays, there are many tools available that allow us to share knowledge. So, and that may be any kind of solution like SharePoint or other third-party solutions that basically provide the possibility to have a one-point access for any matter, in this case transfer pricing or tax. And it basically allows you to put there all the relevant documents and procedures to be shared by the persons that are responsible for each of these tasks within the framework. So it also allows version control. People always know that they have the latest versions. And some solutions even have the possibility to provide tasking and delegation functionalities. Basically providing, let's say, the task that need to be performed by each of the responsibles, and providing the central responsible person the possibility to see whether these are actually being complied with. And finally, these portals, they also provide the possibility to answer questions in the form of frequently asked questions or manuals, etc. And finally, the other part of the technology, which is also important, is the integration of the transfer pricing policies in the accounting or RP systems. Nowadays, there are many modules available that allow a group to do separate reporting for transfer pricing purposes. These can either help the company to apply the appropriate pricing mechanisms in terms of the correct price or margin, but they also facilitate the automatic collection of financial information on the related party transactions. That is very important because there are very large groups that sometimes do not have the information about related party transactions readily available, simply because these transactions are not marked as such in the system. So it's very important that to effectively monitor the transfer pricing policies, that this information is readily available, because if not, it's going to cost a lot of time for each of the responsibles to collect that information manually. So this is my point. I will transfer the mic to Jay-Tan.
Thanks, thanks, Richard. Hi, everyone. My name is Jay-Tan. I'm a transfer pricing director of BDO China. So in this section, I will basically discuss with you how to manage transfer pricing from a China perspective. Transfer pricing has been a very hot topic in China for many years. So what is the current forces shaping transfer pricing landscape in China? China is aware of the importance of transfer pricing and the transfer pricing concepts through many efforts. We've seen a huge growth of the number of full-time transfer pricing specialists within the tax system in China. And we even see some dedicated team of transfer pricing in certain cities such as Beijing, Suzhou, and Shanghai, whose responsibility is taking care of transfer pricing in all aspects. China holds different opinions of some key transfer pricing concepts when negotiating with competent authorities overseas. Those different opinions are especially related to some China-specific topics, such as simple function entity, location-specific advantages, etc., etc. China is also open to divergence from traditional arm's length standards. For example, China is emphasized more on the comparability when applying of transaction net margin method, and tax bureaus in China has been trying to apply profit split method in more and more cases. When considering the general slowdown of China economy, China Tax Bureau has received more and more burden on tax collection from the government. So all these lead to the increased risk and uncertainty for taxpayer regarding to transfer pricing in China. Now let's look at the China and general anti-avoidance. There are generally three basic pillars who are service, investigation, and administration. The first pillar, service, refers to APA and bilateral consultation. But APA, especially bilateral APA, has been a very useful tool for multinational companies to resolve double taxation between China and the competent authorities. We see there are a huge number of APA application and also APA case conclusion, which covers many, many different countries, for example, US, Japan, Korean, and some European countries. And those APA cases also covers lots of industries. However, we also see a large case backlog in the pipeline, which with more than 100 application of bilateral APA, as comparing to the very limited resource of the transfer pricing specialist within the tax system in China. The second pillar is investigation that refers to TP audits, covering the transaction types of tangible assets, service transactions, intangibles, and equity. We've seen that tax bureaus in China intend to obtain large tax adjustments amount from limited TP audit cases. We noticed the average tax adjustment amount in year 2013 is almost about $3.5 million for each case. The third pillar is administration that refers to routine anti-avoidance administration, including review of TP documentation on a national scale, self-assessment, and follow-up administration after TP audit. The review of contemporaneous TP documentation is almost about 100%, which means that the local tax bureaus, they collect 100% of the surprising documentation from taxpayers who are over certain threshold. And the tax officials are also focusing on the quality of those transfer pricing documentation reports. They are trying to select potential targets for transfer pricing investigation, and they also require taxpayers to conduct self-assessment on their transfer pricing position. Then what is the local country practice for China? The first one, when applying transaction net margin method, China is more focusing on the comparability. And also, on the other hand, the tax officials are always trying to apply profit split method in many, many cases. China is also fighting very hard for the fair share of profitability of the multinational companies in China through quantification and allocation of local specific advantages. These local specific advantages include cost advantages, for example, low labor costs in China, low property costs, and some other incentives when multinational companies set up their company in China. Market premium, which refers to the situation that certain brands may have special value to the customers in the local China market. Local marketing intangibles that the Chinese subsidiaries grow through its day-to-day business operation. The third thing that for local country practice in China is identification and evaluation of intangibles. China Tax Bureau has grown many methods, for example, market methods, cost methods, profit methods, to evaluate intangibles. And lastly, China Tax Bureaus, they are growing with some practical issues and solutions rather than applying a general approach for certain things regarding to transfer pricing. When talking about BEPS, China has playing a very active role in BEPS discussion. They have their own focus from a BEPS perspective. For example, full consideration of market factors in transfer pricing, especially the local advantages that I mentioned in the previous slide. They are also trying for the taxing rights, which must be consistent with economic activities by emphasizing substance over form. And China is also fighting for the Chinese entities' share of the group profits throughout the whole supply chain. What are the divergences that China holds? For example, the key people function, which regarding to the valuable contribution of strategy versus execution, creation of intangibles, whether there is local intangible created other than the centralized IP, manufacturing as a source of IP, whether manufacturing know-how for specific China customers contribute any profit to the whole supply chain, management services versus key people function, who really conduct management activities, and the value to China's performance. So here I just quoted 15 unacceptable taxpayer behaviors, which were mentioned by a tax official of SAT in an international event. I don't want to go through details of these 15 behaviors with you, but I just want to emphasize some of that. For example, number 6, unreasonable charging of expenses. We know that China is emphasizing more on the remittance, which are paid by the Chinese subsidiaries to the overseas company, especially the headquarter charge, some supporting services, and the royalties. Number 7, loss-making simple function entities, which refer to Circular 363, that Chinese Tax Bureau hold the aggressive requirement of stable profitability of simple function entities. Number 11, low remuneration of high-tech enterprises. The high-tech enterprises is a special tax incentive for corporate income tax reduction from a statutory 25% to a 15%. And in practice, we see Chinese tax bureaus, they are having a high expectation on the profitability for those high-end new tech enterprises. Number 12, lack of consideration for China-specific market factors. This has been covered in the previous slides. And finally, number 14, company uncooperative in providing documentation. Always bear in mind there is a 5% interest levy on the tax adjustment, even that the taxpayer has prepared the documentation, but the documentation report tends to be a poor one. So how should we manage transfer pricing risk in China from a practical perspective? Those are some key suggestions that you can take away with you. First, review profit level of related party transactions periodically to make necessary price-profit adjustment if applicable. Secondly, review the arm's length nature of transfer pricing policies on a continuous basis, especially when there is a change in business operation or regulatory environment. Thirdly, assess our overall supply chain profitability with reference to other players' profitability in the same industry. Fourthly, caution needed in responding to any query related to company's profitability or related party transaction or disclosing anything that may arouse tax bureau's interest. Finally, ultimate measures would be an application for an APA to obtain certainty on transfer pricing position. So our recommendations for taxpayers for multinational companies in China. The first area is always bear in mind the China conscious. So always consider the impact of China-specific factors, the LSAs, to understand the regional and national audit approaches, and to approach adjustment horizontally, compare with peers and competitors. And the second very important thing is always bear in mind, even when just conducting planning, always bear in mind for an audit-ready position. So just bear in mind how the tax bureau will regard if they conduct a TP investigation, especially for a TP planning project. So that's so much for the China one. So I'll handle my driver's seat to Anton for the closing.
Well, thank you, Jay. Thank you very much indeed. So thank you to all of you for holding on for a little longer than an hour. Please bear with me for another 2 minutes. I just want to address very briefly what we have taken away from today, or certainly what I've taken away from today. Firstly, we've entered a more complex and no less uncertain environment for transfer pricing, with arguably more scope for controversy, and therefore taxpayers may well seek greater certainty as to outcomes with advanced pricing agreements. For instance, transfer pricing and planning associated with it needs to be underpinned by appropriate economic substance and control functions exercised by the right people from the right place. Transfer pricing has moved on. It's an holistic view of the value chain, which is now the norm in terms of reviewing appropriate transfer pricing. Proper implementation and good supported documentation is absolutely key. Managing and monitoring transfer pricing on an ongoing basis is critical, and it's more critical than it's ever been, and this needs to be embedded within the business to ensure that you're following your policies correctly and appropriately. And finally, different tax authorities will often have different views with regard to how the arm's length principle should be applied, the emerging economies in particular, and it's important to anticipate and to address this particular issue. With the introduction of new transfer pricing documentation standards, and in particular with country-by-country reporting next year in particular, now is the time to road test your transfer pricing policies, to test underlying substance and control over functions and risks, and to ensure that your internal controls are sufficient to manage and monitor properly implementation of transfer pricing policies. So all that's left for me to say is to ask you to contact any of the speakers today or your usual BDO contact if you'd like to discuss any issues. For those who've got unanswered questions posed in the Q&A, and we've had a flood of them in the last 10 or 15 minutes, we will do our level best to respond individually to you as soon as we can. Thank you very much for joining us today. Thank you very much to the speakers. If you want to look at the materials, we will circulate the recording and the slides later on. The next webinar in our series will cover compliance traps and is scheduled for the 25th of August, so please join us for that. Further information will be provided in due course, but you can register via the BDO website in the meantime to save the date. That concludes the seminar. Thank you.